Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending June 17th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is it's a central banker's world after all. A little bit on that in just 1 minute, but let's just kind of take a look at where we've been this past weekend. It was an ugly, ugly, ugly week. So if we take a look at the index performance, you can see on a weekly basis, the Russell was down over almost 7.5%. Nasdaq down almost 5, S&P almost 6%, Dow almost 5% just for the week. Year to date, you can see the Dow is moving closer and closer to a bear market. S&P moved into a bear market this week. Nasdaq and Russell have been in a bear market for quite some time. You can also see the forward PE ratio for the S&P is now down to 1610. It was up over almost 22 at the beginning of this year. So that's a big drop in valuation. I think it's going lower. You can see the dividend yield of the S&P came in at 1.6%, 10-year Treasury. Although it was a lot higher, it came down and closed the week at 3.24%. The earnings yield for the S&P is at a little over 5.5%, but that's assuming the E in the numerator, which is 205 for the estimated earnings per share, is actually 205. If that starts dropping and we start seeing more and more earnings revisions to the downside, which is what I believe, then the earnings yield is going to come down. The S&P yield over the 10-year Treasury is 2.32%. The real yield, when you factor in inflation, is still a negative over 3%. And you can see the current VIX finished the week at 3113. It was up about almost 11% for the week from a prior week's close at 2775. And energy got killed on the week. The energy worst performing sector down 17% for the week. That's an annual number. It's still, as you can see, the best performing sector for the year, but it cut a lot of that performance down. Now it's only up 33.6%. Discretionary is the worst for the year, down 33%, almost the exact opposite of energy. The best performing sector for the week still finished down 4.3%. It was a really an ugly week for the week. In addition to the S&P moving into a bear market, the percentage of S&P companies that were trading above their 50-day moving average is below 5% now, almost a flush. That's the lowest level since the pandemic fears really creamed the shares about 2 years ago. Every member of the S&P 500 at one point has been in negative territory, and we haven't seen that since 1996. And if you look at the advanced decline ratio in the New York Stock Exchange, the NYSE, about 3,000 companies in there, it's been the most negative it's been since 2007. So this is a reason from the contrarian perspective, or i.e. our red stripe zebra approach, we're probably going to see a little bit of a bounce, but don't get suckered in. If you want to do a swing trade, you want to day trade it to the upside, that's okay. But I suspect it's going to run up, and then July is going to give us another ugly down move, probably taking out the lows that we've already seen this past week. I'll show you the chart in a minute. Meanwhile, if we take a look at some of the things that came up this week, some of the economic data, and we'll look at U.S. Treasuries, the Fed, they met this past Wednesday, and instead of hiking 50 basis points, they hiked 75 basis points. They gave the markets a 2-day, 3-day heads up that they're going to do that through the Wall Street Journal, and then other journalists started picking it up. 75 bip hike. So now our target range is 1.5 to 1.75%. That's the highest it's been since 2020. And there are several reports also that show the housing sector already feeling the impact of Fed tightening. Surge in mortgage rates. Right now, 30-year mortgage is around 6%. That's up from 3% early this year, late last year. That translates, guys, just so that you understand, into a 44% increase in a monthly payment on a $300,000 mortgage, okay? Not only that, but credit card rates are going to be heading towards 20%. So the consumer is going to be impacted big time, especially in the real estate market. We're already seeing some realtors laying off people. So that's only the beginning of it. We're also seeing that the Building permits fell 7% in May. That's the lowest level since last September. Housing starts sank down to 14.4%. That's the biggest drop since the onset of COVID. Weekly jobless claims came in a little bit higher, okay? And the mid-Atlantic factory activity fell, contraction. It's the first since May of 2020, okay? Retail sales data, meanwhile, further stoked recession fears. Overall sales fell 30 basis points in May, dragged lower by a sharp decline in auto purchases, right? Partly reflected by higher rates on car loans. And then we're getting inflation and rate fears. We're seeing that push the 10-year note up to almost 3.5% earlier this week. And then it finished out, as I said here, you can see on the screen at 3.24%. And we're starting to see, not yet, but spreading yields between investment grade and junk bonds in the corporate market. So we got to keep a very close eye on this, okay? And then, of course, if we look over in Europe and we take a look at just what's going on there, everybody's in the red. The Euro stocks, the 50 largest companies across Europe, FTSE, CAC 40, DAX, all over 4% to the downside this week. Year to date, the Euro stocks, the 50 largest companies, moved into a bear market territory. FTSE, which was barely hanging into the green this year, gave it all up. Now they're down. CAC 40, DAX, also close to a bear market this year. The Nikkei, well, in Europe, before we get into the Asian markets, we did see not only did the Feds hike the rate 75 basis points this year, but the ECB had an unscheduled meeting because they were starting to get some wider dispersions in bond yields from Italy and Greece and the German Bund market. So they had an emergency meeting to just let the markets know they're not going to let that happen like the debt crisis back in 2013, 2014. So they're going to try and jump on that earlier. Meanwhile, the Swiss National Bank, they surprised the markets, raised rates for the first time in 15 years by a half a point, 50 bips. They're still negative 25 basis points, but they came out and surprised the market. So we've got all of that action going on. Meanwhile, the Bank of England, they raised their key rates to 1.25%, an increase of 25 bips as well. So we're seeing, as I said in the title suggests, it's a central banker's world. After all, they're all starting to move in unison to hike the rates. Okay. Also in the UK, official data showed that their economy shrank 30 basis points in April after contracting 10 basis points in March. So we're seeing not only a global move in central banks hiking rates, but also a slowing of growth. So raising rates in a slowing growth market is not where the Feds or any of these central bankers want to be. That's why you're hearing words of stagflation being tossed around. Okay. Now, unlike their global peers, Japan is one of the few central banks that's maintaining their ultra low interest rates, and in their monetary policy meeting, they kept their overnight interest rates at a minus 10 basis points and said they would still conduct daily purchases of the 10-year Japanese government bonds. Okay. So they've got a very artificial market. At some point, this thing's going to blow up in Japan and it will wash to our shore. But right now it hasn't. But they're ultra stimulus is what they're doing in Japan. And over in China, you can see they're the only index this year or this past week that managed to finish in the green. But this is just more of a dead cat bounce from just the cratering that China had last year. And they're just now starting to open their economy back up from another complete shutdown with their zero COVID policy, which to me makes absolutely no sense. But politicians or dictators are not necessarily the smartest people in the batch. But that's what's going on there. And the Chinese labor market is also showing signs of weakness. The unemployment rate in the 31 major cities across China is up almost 7%. That's a record high for China, while their youth jobless rate is almost a little over 18%. So they're all getting crushed, right? Just not a very pretty picture in the global economy right now, as evidenced by the complete revaluation here in the US. Although it's been an orderly move lower, I don't think we're going to have that blow off bottom that some analysts want to see where the VIX just goes up over 40. The VIX seems to be stuck when it does move down harder in the 30 to 35 VIX range. And I think it's just going to be a rolling thunder kind of thing until the markets get to a point where we see buyers step in. Now, I do believe we will have a bounce, probably, and then if not starting this week, next week, and then again, just as a reminder for all non U.S. folks watching this, Monday is a U.S. holiday, so it's a long weekend, Juneteenth for the U.S. market. So the markets will be closed on Monday. As usual, the futures market will open 6 p.m. Eastern time in U.S. markets and then close Monday, I believe, at 1 p.m. Eastern Standard Time as normal. So I'm going to shift the screen over and let me just take you guys to the charts. We'll just spend a few minutes on these just to kind of show you guys what I'm looking at. I'm going to start with the E-mini S&P 500 futures. Let me get that out there. It'll take a couple of seconds to come on the screen. And then once you get it, we'll move through it. So now if you look at this, you're going to see here that the markets hit a low, intraday low on Friday. We came down 36.39. We hit a low. You could see the S&P move down. It was down 24.32%. Now, I had given the markets a range to our members, and I think I mentioned to you guys too, 38 to 3,700. I'm sorry, 37 to 3,600. And moving it down here, I do believe we're going to get a bounce back up. But again, it's going to be like every other bounce. Then this bounce could give us a 5 to 10% move higher and then a roll back over again. And then in July, we're going to take these lows out and probably go down to the 34 to 3,500 area. And then I think the valuations would be better suited for bigger money to come in and take longer term positions. You can see here my target, my original target was 37.30. We came down to 36.83. We hit an intraday low, 36.39. The momentum just carried us down. And I think we're going to settle in somewhere around this area here. And then we'll start to see a little bit of a bounce. If I show you this other chart that I've been showing you for a while now, this is the Andrew's pitchfork. The blue line is kind of a secular growth line, bullish growth line. You can see we came right down and hit it. We're bouncing around here. To me, the bottom number is right around 3,400. Okay, now I said 34 to 35. If we come down to 3,400, that'll take us right back to the pre-pandemic high. You can see here we're at 3393.92, and then we rolled over during the COVID crisis. So that'll be my longer term support point over the next couple of months. You can see the 50% fib extension, retracement takes us down to 3,500. So looking at these new ranges, I would probably project out through August 35 to 3,400 is our new range. Now it was 38 to 37. We blew through that and then just kind of went quickly below, but I've kind of shifted it now based on the data points that I'm seeing. You can also see here with the MACD, there is no bullish divergence in this. There is none at all. So that's kind of what I'm looking at, guys. And if we come over here and come back to the chart and we look at the Nasdaq, which is probably going to be a little bit more worse for wear in here, you can also see in the Nasdaq, we hit the low for the year in Nasdaq on the 16th, not the 17th, and we were down almost 34%. But again, it's given us an Elliott wave 3-4-5 pattern, so that suggests a little bit of a bounce back up and then a possible roll back over again. So that's what I'm looking at, guys. I just don't think it's going to be that pretty. And then, of course, if we come down here and look at treasuries, we look at the bond market. I got our members short bonds in Q4 of last year, or short TLT. And you can see we went right down to my target and then kind of went just slightly below it, just a little bit. And now we're sitting right here at 2022 lows. Okay. So that's a little bit about what I'm seeing right now in this. And I think even on Friday, we just hit just a very small lower low, 131.01 right here, right? So that would be the low and for the bond market, okay? I see a little bit of a divergence, but not much. So we will get a little bit of a bounce here, but I think it's going to roll back over. Okay. And then, of course, if we look at the 10-year interest rate, I think I'd shared this with you. My target for the 10-year was up here around 132. You can see, as usual, we overextended to the upside and then roll right back over. So we're going to hover in this area for a while, all right? And then we're going to kind of drift a little bit lower as, you know, the longer term on the further end of the yield curve out on 10-year, especially the 30-year, I think we're going to see that come down. I just don't think the markets have a lot of confidence in the growth of the U.S. markets going through the end of this year into 2023. I see some analysts saying that we're going to now's the time to buy and load up because we're going to make new all-time highs. I don't see it. But a lot of it's going to depend on what the Feds do and what kind of data we get from the CPI and inflation. So there's a lot of, we can go kind of like down the yellow brick road. We can take the left or we can take the right at the fork. And right now it's really hard to determine what does the path look like going to the right or going to the left. So we have to price in what looks like a downside and play that. And then if you're surprised to the upside, so be it. That'd be a better way to go than be surprised to the downside. Okay. And then of course, if we look at the dollar, really strong finish on Friday, up over $1. You can see here the dollar, well, let's close that down. The dollar actually made new all-time highs here. I got to move it over. It's given us that 3, 4, 5 Elliott wave pattern. So I do believe the dollar is going to come back down and test the 50 EMA again. That would take us down to 102. I've been saying for a while now, I'm looking to get long the euro, right? Which would be the same as shorting the dollar. And you could see the euro is trying to bounce off of that low that was made back on May 13th. Okay. And we'll see how it goes. It's got to get over the 50 EMA. You can see where the euro is it's just having a hell of a time getting over it. So I want to see how it reacts to that. And that's going to determine whether I want to go long euro, short dollar kind of play, or just go long the euro in the euro futures market. Okay. And of course, the yen, well, obviously we know why this thing just keeps going lower and lower, and that's because the Central Bank of Japan has diverged dramatically from the U.S. They're really one of the few banks that's putting stimulus into the economy. You can see this 3, 4, 5 pattern. I do believe we'll get a little bit of a bounce up, but it's like catching a falling knife. Until we can get a sustained move over the 50 EMA, I wouldn't touch it, right? And then, of course, if we come down to the gold markets, as I've said, and I've told our members, we have one way to trade it and one way only, and we can make money in it. But outside of that, I think gold is just going to continue to go lower. My target for gold over the next couple of months is down to about below 1800, down to about 1761, somewhere in that area right there, which means we're going to make new 2022 lows. Okay. The prior low in 2022 was earlier in the year at 1778. I think we're going to take that out, right, by about 10, 20 points, something like that. Okay. Silver, look at silver. Silver is worse off than gold. It's closer to the lows. The 50's below the 200 in silver. It's not like that in gold. The 50's above the 200. We don't see diverging patterns like that very often between silver and gold. One tends to follow the other. In this case, I think gold is going to catch up with silver, but to the downside, unfortunately. Okay. And then, of course, if we look at energy, energy just got totally hammered. Big, huge down move through the 50 EMA. Again, there's only one way to trade oil, same as the silver markets, and you can make money doing it that way. But if you try and trade it directionally, you better be day trading it, because swing trading is very difficult in the oil markets right now. There's a lot of risk premium in the price of oil, given the problems over in Ukraine and Russia, and then just the current administration policies. They're just really, they're fakakta if you're an oil company, very difficult. So I think it could come down a little bit lower and then make another final run up, and then that'll be it for oil. Okay. Nat gas also had an ugly move, really ugly move, right? Nat gas is giving it all up. It's come down hard. I think it's going to make a run up, an attempted pass to the 50 EMA. If it fails, then it's going to just run down and find support, probably a little bit lower. I said support around a little over 6, right in this shaded zone right here. Okay. So we'll see how all of this stuff plays out. Okay. All right, everybody, that's a quick review of the markets and some of the major asset classes, from equity to debt to some of the key commodities. Members, even though Monday's a holiday, I will see you Sunday evening. We'll go through some things and just kind of see how markets are shaping up over the next 30 to 60 days. Have a great weekend, everybody. U.S. members, enjoy the long holiday weekend. Ciao, everybody.